Imagine waking up on your 73rd birthday, thinking you have finally crossed the finish line of a 40-year career only to realize that you have been walking straight into a financial trap that was set decades ago. Most of us have been taught that the goal of retirement planning is to save as much as possible in tax-deferred accounts because we will be in a lower tax bracket when we retire. That sounds great on paper, but for a huge number of Americans, it is a complete myth. In fact, for many of you watching right now, the exact opposite is going to be true. You are going to be in a higher tax bracket in retirement than you ever were during your peak earning year. And the primary reason for that is a massive tax bomb waiting to go off. When you hit age 73, if you are sitting on a large traditional IRA or a 401k, and you are planning to just let it sit there and grow until the government forces you to take the money out, you are making a mistake. That could cost you hundreds of thousands of dollars in unnecessary taxes. This is especially urgent because of the 2026 warning. At the end of 2025, the current tax laws are scheduled to sunset, which means in 2026 tax rates are going up across the board for almost everyone. If you do not have a plan to get your money out of these 5 specific accounts before you hit that age 73 milestone, the IRS is going to become your biggest beneficiary, and they are going to take a piece of everything you worked for. We need to talk about the reality of the required minimum distribution, or the RMD. For years the age was 70 and a half, then it moved to 72. And now thanks to the Secure Act 2.0, it is 73, and will eventually move to 75. On the surface, this looks like a gift from the government giving you more time for your money to grow tax deferred. But in reality, it is a double-edged sword. Every year, you leave that money in the account and let it grow. You are increasing the size of the mandatory withdrawal you will have to take later. And because those withdrawals are taxed as ordinary income, they can push you into a higher tax bracket trigger higher Medicare premiums, and even cause your Social Security benefits to be taxed at a higher rate. It is a domino effect that can wipe out your monthly cash flow. I want to break down the 5 specific accounts you need to look at right now, and why 2026 is the deadline you cannot afford to ignore. If you find this information valuable, please consider subscribing to the channel and sharing this with someone. WHO is nearing retirement because these rules are changing fast, and most people are going to be caught off guard. The first and most common account on this list is the traditional IRA. This is the bedrock of retirement for millions of people, but it is also the biggest source of tax liability. When you put money into a traditional IRA, you got a tax deduction on the way, in which felt great at the time. But that money has been growing for 20, 30, or 40 years, and every single penny of that growth is fully taxable at your highest marginal rate when it comes out. The problem with waiting until age 73 is that the IRS calculates your required distribution based on your total account balance and your life expectancy. If your account has grown to $1 million or more, that first RMD is going to be a massive chunk of change. If you do not need that money to live on, it is just extra income that you are being forced to take and forced to pay taxes on. This is where the 2026 warning comes in. Right now, we are living in a period of historically low tax rates. The 12% bracket, the 22% bracket, and the 24% bracket are all scheduled to jump back up to 15%, 25%, and 28% respectively in 2026. If you wait until you are forced to take distributions at age 73, and that date falls after 2025, you are going to be paying those higher rates on every dollar. The strategy here is not to wait for the IRS to tell you when to take your money, but to start taking purposeful distributions now, while rates are low, to fill up your current tax bracket. It is much better to pay 22% on a distribution today than to be forced to pay 28% or 32% on a much larger distribution 5 or 10 years from now. The second account you need to be wary of is your employer-sponsored 401k or 403b. Many people reach retirement and just leave their money in their old company plan because it is easy. But these accounts carry the same RMD risks as a traditional IRA with an added layer of complexity. If you are still working at age 73, you might be able to delay your MDs for your current employer's place. But for any old 401ks from previous jobs, the clock starts ticking the moment you hit that age threshold. A lot of people have 3 or 4 different accounts scattered across different companies. And if you forget just one of them, the penalty used to be a staggering 50% of the amount you were supposed to withdraw. Well, that has been reduced to 25% or even 10% if corrected quickly. It is still a massive and unnecessary loss. Beyond the penalty, the real danger of the 401k is that it often represents the largest portion of a person's net worth, and because it is all pre-tax, it acts like a ticking tax time bomb. If you are finding this breakdown useful so far, hitting the like button really helps get this information out to more people who are trying to navigate these tricky IRS rules. When we look at the 2026 tax cliff, you have to realize that your 401k balance is not actually yours. A portion of it belongs to the IRS, and if you do not settle that debt now, through strategic withdrawals or Roth conversions, you are essentially betting that taxes will be lower in the future, which is a very risky bet given our national debt and the scheduled sunset of the current tax laws. Moving to the third account, we have to talk about the SEP IRA and the Simple IRA. These are popular for small business owners and freelancers, and they are fantastic for aggressive saving during your working years. However, because they function similarly to a traditional IRA, they are subject to the same RMD rules. The catch here is that many small business owners continue to work well into their 70s, and they often that because they are still contributing or still active in the business. They can ignore the withdrawal rules. That is not the case for these specific IRA-based plans. Once you hit 73, the government wants their cut. For a business owner who might have other sources of income, like rental properties or business dividends, being forced to take a large RMD from a SEP IRA can be the tipping point that pushes them into the highest possible tax bracket. It can also trigger the net investment income tax, which is an extra 8% tax on your investment income if your adjusted gross income exceeds certain thresholds. By taking distributions earlier, especially in the years leading up to 2026, you can flatten your tax curve and keep more of your hard-earned business income in your own pocket. The fourth account is one that many people do not think about until it is too late, and that is the inherited IRA. If you have inherited an IRA from a parent or a loved one who passed away after 2019, the rules have changed drastically thanks to the Secure Act. In the old days, you could stretch those distributions out over your own lifetime, which allowed for decades of tax-deferred growth. Now, for most non-spouse beneficiaries, you are required to empty that entire account within 10 years. If the person you inherited the account from was already taking RMDs, you may also be required to take annual distributions during that 10-year period. This is a massive tax trap because many people inherit these accounts during their own peak earning years when they are already in a high tax bracket. Adding an extra $50,000 or $100,000 of forced distributions on top of a high salary can result in nearly half of the inheritance going straight to the IRS. If you are approaching age 73 yourself and you also have an inherited IRA, you are facing a double whammy of forced income. You have to be extremely strategic about which account you draw from first and how you manage those withdrawals before the 2026 tax hike makes the situation even worse. The fifth and final account is actually a combination of accounts that create what I call the stealth tax, and that is your taxable brokerage account. When combined with your Social Security, while a brokerage account does not have RMDs, the income it produces in the form of dividends and capital gains counts toward your provisional income. When you hit age 73 and you are forced to start taking large RMDs from your IRA and 401k, that income is added to your Social Security and your investment income. Once your total income crosses a relatively low threshold, up to 85% of your Social Security benefits become taxable. This is the tax torpedo that many retirees never see coming. You worked your whole life and paid into Social Security, only to have the government tax those benefits because they are forcing you to take money out of your other retirement accounts. By drawing down your traditional IRA and 401k balances before you hit 73, you can reduce the size of those future RMDs and potentially keep your income low enough to protect your Social Security from being heavily taxed. The reason 2026 is such a critical year in this conversation is because of the Tax Cuts and Jobs Act. When this law was passed in 2017, it lowered tax rates for almost everyone. But those changes were not permanent. They are set to expire at midnight on December 31st, 2025. Unless Congress acts, which is never a guarantee, the standard deduction will be nearly cut in half, and tax rates will revert to their older higher levels. This means that 2024 and 2025 represent a golden window of opportunity for retirees and those nearing retirement. It is essentially a limited time sale on taxes. If you can take money out of your pre-tax accounts now at a 12% or 22% rate and move it into a Roth IRA or a brokerage account, you are locking in those lower rates. Once that money is in a Roth IRA, it grows tax-free for the rest of your life. And there are no RMDs for you as the original owner. This is one of the most powerful tools in retirement planning. But you have to be willing to pay some tax today to save a lot of tax tomorrow. I know it feels counterintuitive to voluntarily pay taxes when you do not have to. We have been conditioned our entire lives to defer. But deferring is only a good strategy if you expect to pay a lower rate in the future. With the 2026 cliff approaching and our national debt at record highs, it is very hard to make a logical case that tax rates will stay this low forever. Think of it like this: if you had a credit card balance and the bank offered to let you pay it off today at a 20% discount, but warned you that next year the price would go up, would you wait? Of course not. Your pre-tax retirement accounts are a debt you owe to the IRS, and right now the debt is on sale. If you wait until age 73, the sale is over and you are forced to pay whatever the current rate is on a balance that has likely grown much larger. Another huge factor to consider is the impact on your heirs. If you leave a large traditional IRA to your children, they are going to inherit the tax bill along with the money. Because of the 10-year rule I mentioned earlier, they will be forced to take all of that money out and pay taxes on it during what will likely be their highest earning years. By taking the money out now and paying the tax at your current rate, you are actually leaving them a much more valuable gift. A $500,000 Roth IRA is worth significantly more than a $700,000 traditional IRA once you account for the taxes that have to be paid. You are doing them a huge favor by cleaning up the tax liability before you pass the assets down. We also have to talk about Medicare because this is one of the most overlooked consequences of hitting age 73 and being forced into our MDs. Medicare Part B and Part D premiums are not the same for everyone. They are based on your income through something called IRMAA, or the Income-Related Monthly Adjustment Amount. If your RMD pushes your income just $1 over a certain threshold, your Medicare premiums can double or even triple. This is a stealth tax that does not show up on your 1040, but it absolutely hits your monthly budget. Because IRMAA is based on a 2-year look back, what you do at age 71. And 72 will determine what you pay for Medicare at age 73 and 74. By managing your withdrawals and reducing your RMDs before they start, you can keep your Medicare costs low and keep more of your fixed income for your own needs. So what is the actual plan of action? First, you need to look at your total balance across all pre-tax accounts. That is your traditional IRA letters for 101 kiloseconds for O3 BS SEP and simple IRAs. Add them all up and realize that roughly 20 to 30% of that number is not yours. Then look at the current tax brackets for this year and next year. See how much room you have in your current bracket before you jump to the next one. For example, if you are in the 12% bracket and you have $30,000 of room, before you hit a 22% bracket, it might make a lot of sense to withdraw $30,000 or convert it to a Roth. You are essentially filling up that lower bracket and getting the money out at a known low rate. If you do this every year between now and age 73, you can significantly reduce the size of the tax bomb that is waiting for you. You also need to think about the sequence of returns and the sequence of withdrawals. Most people spend their taxable money first because it is easy, and they want to let their tax-deferred money grow. But that is often the exact wrong way to do it. If you spend your taxable brokerage money first, you are letting your biggest tax liability grow larger and larger. A better approach for many is to spend from the pre-tax accounts early in retirement to bring those balances down and let the taxable or Roth accounts continue to grow. This lowers your future RMDs and provides you with more tax-free flexibility later in life, when health care costs might be higher. There is also a very special tool for those who are already over age 70 and a half, called the Qualified Charitable Distribution, or QCD. This allows you to send money directly from your IRA to a qualified charity, without that money ever hitting your tax return. It counts toward your RMD, but it is not included in your adjusted gross income. This is a brilliant way to satisfy the IRS requirements while also supporting causes you care about and keeping your income low to avoid things like the Social Security tax or Medicare premium hikes. Even if you do not consider yourself a huge philanthropist, most people are giving some money to a church or a local nonprofit. Doing that through a QCD is far more tax efficient than taking a distribution paying tax and then writing a check. As we move toward 2026, the window of opportunity is closing. Every month that goes by is a month you could have been strategically shifting your wealth from the taxable bucket to the tax-free bucket. I know this can feel overwhelming, but the key is to start with a clear picture of where you stand. Most people are surprised when they actually do the math and see how much the IRS is going to take if they just stay on autopilot. Retirement should be the time when you have the most control over your life and your finances. But if you let the RMD rules dictate your income, you are giving that control back to the government. I want you to think about your retirement as a long journey where the weather is about to change. Right now the sun is out and the tax rates are low, but there is a storm on the horizon in 2026. And another one when you hit age 73. You would not wait for the rain to start before you looked for shelter. You would prepare ahead of time. Taking action now, whether it is through Roth conversion strategic withdrawals or utilizing QCDs, is how you build that shelter. It is about being proactive instead of reactive. The people who are going to thrive in this new tax environment are the ones who are willing to challenge the old wisdom of deferring taxes forever. Remember that the goal is not to pay the least amount of tax this year. The goal is to pay the least amount of tax over the rest of your life. Sometimes that means paying a little more today to save a fortune tomorrow. It is a shift in mindset that can be the difference between a retirement of abundance and a retirement of constantly looking over your shoulder at what the IRS is going to do next. You have worked too hard and saved too much to let a simple age milestone and a scheduled tax hike derail your plans. If you have stayed with me this far, it is clear that you are serious about protecting your future, and I truly appreciate your time. This channel is all about digging deep into these complex topics and making them actionable, so you can make the best decisions for yourself and your family. If you haven't already, please hit that subscribe button and turn on notifications because the rules are going to keep changing, and I will be here to help you navigate them. The 2026 warning is real, and the age 73 deadline is closer than it looks. Take a look at those 5 accounts today and start making your plan to get that money out before the IRS takes more than their fair share. In conclusion, the next few years are going to be some of the most important years for your financial legacy. The combination of the Secure Act changes and the 2026 tax sunset has created a unique situation that we have never seen before. It is a perfect storm for the IRS, but it is also a massive opportunity for you, if you are willing to take it. Don't let your 73rd birthday be a day of financial regret. Start those withdrawals now, manage your brackets, and take control of your tax destiny. You have the tools and the knowledge to protect what you have built. Now it is just about taking that first step and making the move before the clock runs out. Thank you for watching, and I will see you in the next one, where we will continue to break down the strategies that keep your money where it belongs, in your pocket. We often talk about the math of retirement, but we rarely talk about the peace of mind that comes with it. There is a certain weight that is lifted when you know that your tax liability is managed and that you won't be hit with any massive surprises in your 70s or 80s. That peace of mind is worth the effort of planning today. It allows you to focus on what really matters in retirement, which is spending time with your family, traveling, and enjoying the fruits of your labor without worrying about the government's hand in your pocket. The complexity of our tax code is designed to catch people who aren't paying attention. It is a system that rewards the informed and penalizes the passive. By staying educated and being willing to adapt your strategy, you are putting yourself in the top 1% of savers who actually understand the mechanics of wealth preservation. Most people will just keep doing what they have always done, and they will pay the price for it in 2026 and beyond. You are choosing a different path, and that is going to make all the difference for your future. As you look at your accounts, remember that every dollar you move out of a pre-tax environment today is a dollar that can never be taxed again if you move it into a Roth. It is a permanent solution to a recurring problem. The IRS wants you to wait. They want your accounts to grow as large as possible because they are a silent partner in those accounts. When you take the money out now, you are essentially buying out your partner at a discount. It is one of the best investments you can ever make. I have seen so many people reach 73 and be absolutely shocked by the size of their first RMD check and the tax bill that comes with it. They feel like they have lost control of their own finances. I don't want that for you. I want you to be the one in the driver's seat. Whether you are 62 or 72, the time to start thinking about this is now. The closer you get to that age 73 mark, the less flexibility you have. Use the time you have now to your advantage. Think about the legacy you want to leave. Do you want to leave a complicated tax problem for your children? Or do you want to leave them a clean, tax-free inheritance that they can use to build their own lives? The decisions you make in the next 24 months will determine that answer. It is a powerful position to be in, and I hope you take it seriously. Again, thank you for being part of this community. Your comments and your questions are what drive this channel, and I love hearing your stories of how you are taking control of your financial life. We are in this together, and together we can navigate whatever the IRS throws our way. Stay focused, stay informed, and most importantly, stay proactive. The best time to plant a tree was 20 years ago, but the second best time is today. The same goes for your tax planning. Start today, and your future self will thank you. The road to a successful retirement is paved with good decisions and a few strategic pivots along the way. The shift from the accumulation phase to the distribution phase is the most critical pivot you will ever make. It requires a completely different set of skills and a completely different mindset. You are no longer just trying to grow the pie, you are trying to make sure you get to eat as much of it as possible. Don't let the IRS take the biggest slice just because you didn't have a plan for these 5 accounts. Watch the calendar and keep an eye on the news as we approach 2026. There will be a lot of noise and a lot of conflicting advice, but the fundamentals of tax brackets and our MDs remain the same. Stick to the plan, fill your brackets, and protect your assets. You have worked too hard for too long to let the final chapters of your financial story be written by someone else. Take the pen and write it yourself by taking action before age 73. If you are wondering where to start, just pick one account. Look at that one old 401k or that one IRA that has been sitting there and ask yourself what happens. If I take 10% out this year, run the numbers or talk to a professional who understands forward-looking tax planning. Once you see the impact of that one small move, it will give you the confidence to execute the rest of your strategy. It is all about momentum. One good decision leads to another, and before you know it, you have a bulletproof retirement plan. I want to leave you with one final thought. Retirement is not just an age, it is a financial status. It is the point where your assets can support your lifestyle without you having to trade your time for money. But that status is fragile if it is built on a foundation of tax-deferred debt. By clearing that debt now, you are making your retirement truly secure. You are giving yourself the freedom that you have been working for all these years. That is the ultimate goal, and it is well within your reach. So take a breath, look at the numbers, and realize that you have the power to change the outcome. 2026 is coming, and 73 is a milestone that will be here before you know it. But you are ready for it. You have the information, and you have the plan. Now go out there and make it happen. I will be right here with you every step of the way, sharing the insights and stories that help you stay ahead of the game. Your financial journey is far from over, and the best parts are still ahead. If you plan for them today, remember that every situation is unique, and what works for one person might not be the perfect fit for another. But the principles of managing your tax exposure and being aware of the upcoming changes in the law apply to everyone. Use this information as a starting point for your own research and your own conversations with your family and advisors. The more you know, the better your decisions will be. And the better your decisions are, the better your retirement will be. It really is that simple. Thanks again for watching, for liking, and for subscribing. This community is what makes this work so rewarding, and I am honored to be a part of your financial journey. Keep learning, keep growing, and keep protecting what matters most. I will see you in the next video as we continue to explore the best ways to build and protect your wealth in an ever-changing world. Until then, take care of yourself and your future.